We continue to take a look at some of the movers on the stories here. Diane King Hall is with us, host of Morning Movers, looking at the airlines, one area that is getting some downgrades. And of course, there's pressure across the board.
Yeah, and the airlines had been hit hard recently amid worries about a weakening consumer. And so now you have UBS downgrading their views on both United Airlines and Delta Airlines. We'll start with United. They've gone neutral on United Airlines. Their new price target is 59. That's all the way down from 107. A far cry from obviously what their views were before and where United was trading. You look at that chart, United, the top performer, among the top performers last year in the S&P 500. Definitely a different story this year. It's joining the chorus, UBS joining the chorus of analysts who are concerned about a weakening economic backdrop and increased recession risk. These are some of the key reasons for the downgrade. They expect the tariff to have an impact and to pressure international travel, to add overall strain to just the outlook for United Airlines when it comes to their earnings. They're worried about both domestic and corporate travel. They're projecting that domestic leisure travel will face headwinds. We've already heard even the airliners express concerns about that. They're also expecting corporate travel to soften. They're expecting to see a deterioration in total revenue per available seat mile and just overall revenue in the second quarter and the second half of this year. They're also anticipating weakness in both premium and international travel. For United, that's a key driver for the company, a key earnings driver. So in other words, they just see limited upside from here for United Airlines, Similar story for Delta Airlines, going neutral on Delta Airlines, Nicole. They're dropping their price target to $42 a share, down from 77. That does still suggest some upside from here. But again, you're seeing pressure on both of these stocks this morning. Their downgrade rationale is similar story here. Weakening economic outlook, increasing risk of recession, and just this rise in tariffs and what that will mean for the airlines.
Yeah, and really so much of it is about sentiment, how people are feeling. Will they have a job? Are they facing inflationary pressures? And as you noted, these airlines have spoken and said they are concerned about domestic travel. We don't necessarily have the bounce back in the business travel. There was a lot of that. And I will add, Diane, that, for example, the cruise lines today, Norwegian cruise is down 8.5% after hitting these incredible highs. So the question is the sentiment of the consumer and when that gets broken.
And also, I mean, Delta cautioned about this. They had lowered their guidance in March. They came out, they reduced their first quarter revenue growth projections. They lowered that to between 3 and 4%. That's all the way down from earlier. The projection was between 7 and 9%. So they were already worried and cautious about the consumer. Because we had already seen some flagging. We saw some of that in the sentiment data. So by the numbers, you can see why they had to reduce that. And now we're seeing analysts, especially in this broader market environment, reacting to tariffs, becoming less constructive on the airlines. Because if you're, if the pocketbook of the consumer is weakening, an airline ticket is not a need, especially when it comes to leisure travel.
We're going to get a lot of news this week. Of course, the sentiment prints, things like consumer sentiment, which is soft data, has already shown some weakness. We'll get some inflation prints this week, CPI and PPI. But we're also
Delta Airlines earnings on Wednesday.
Good point. We're also getting the banks on Friday, and I was transitioning to your next story here and looking at some of the banks. We'll be hearing from a few of them, not all that you're covering here today, but you are following some of these
Indeed.
things.
We're seeing Morgan Stanley out with a note on the banks. Some they're more constructive on, some they're less constructive on, but we're seeing pressure across the board. Bank of America tried to shake off that pressure earlier in the session because Morgan Stanley is actually more constructive on B of A. They've upgraded it to overweight from equal weight. They did lower their price target to 47 from 56, but again, they are more constructive on it on a valuation basis. They think their underperformance makes it more attractive on a relative basis. Overall, for the banks, they point to a dimming economic outlook, slower GDP, rising uncertainty, delayed rebound in capital markets. We did expect to see more of a rebound in capital markets this year, so now we're wondering if there are going to be some delays there based on the views of the analysts. They're anticipating some slightly higher net charge-offs and just overall slower loan growth loan growth. So overall, they've downgraded their view as a basket, but because of a heightened recession risk, but they are more constructive on Bank of America. Still shares under pressure along with the broader banks. Goldman Sachs, though, they have downgraded that to equal weight from overweight. So they were certainly more constructive on Goldman before. They've cut their price target to 558 from 659. Again, it's the worries about increased recession risk and that pressuring capital markets activity. Goldman seen as the most exposed to investment banking deteriorating conditions. If there is that there, they're more exposed. They're highly sensitive to economic downturns, and we would see IB revenues react more quickly if there is a recession and deteriorating conditions versus, say, the loan risk, because you'll remember Goldman had pulled out of the consumer business. So, overall, they're seeing large cap banks less constructive, downgraded to in line, just given the weakening macro backdrop, Nicole.
Last but not least, the S&P 500 has now joined some of the other indexes, the NASDAQ 100, the Russell, and the Dow Jones Transportation Average now in bear market territory with the move that we're seeing here. Tesla, for example, is down 10%. Many of the names are down between 5 and 10% this morning. I don't want to minimize what's happening here, but we do have a bright spot for you, and that's a name like Dollar Tree, some of these dollar stores.
Yeah, indeed. So, investors are looking for opportunities, and KG talked about this earlier, to get tactical, and this may be one of those opportunities. Another analyst is sounding off about the value players, the discount players, and could they be a place to position in this environment, especially if you see a larger pullback when it comes to the economy, not speaking of markets. But Citi upgrading Dollar Tree to a buy from a neutral. Shares are higher this morning. Dollar Tree shares right now up 4.5% at the moment. Their new price target is 103, so certainly some upside from here. They previously had a price target of $76 a share. While there is some exposure to tariffs for Dollar Tree, they don't see that as a setback. They see opportunity here. They think their positioning as a value retailer makes them, more attractive in this environment, and likely a winner in retail when prices are expected to rise. Their ability to navigate tariff-induced costs, they think they can do that. They can raise price points, as they believe, from $1.25 or $1.50 to $1.75 more easily, although there was blowback when Dollar Tree raised prices beyond $1 before. But they think they have that opportunity versus other retailers. They are also upgrading their view on Dollar General. Not as much of a positive reaction. It's been, kind of flip-flopping this morning in terms of the market reaction for Dollar General, but they've upgraded that to a neutral from a sell. Their new price target's 101 from 69.
All right, we covered a lot there. Thank you, Diane King Hall.